So there we go, compliance checking. This is all to do, we're going to have a quick run through what the legislation actually requires. This is Schedule 36 of Finance Act 2008. And I've described it in the past as really a statutorily authorised fishing expedition. And that's a big claim. Why do I say it? Well, when you look at the terms of Schedule 36, you see that what it basically entitles the revenue to do is go in and check things. And the purpose of checking things is to check the person's tax position. And you think to yourself, well, fair enough, you know, that's HMRC, that's what they should be allowed to do. But of course, tax position is a defined term. And for a start off, it's not just tax. It covers anything that's a financial transaction in either direction between revenue and taxpayer. So as well as all the sort of normal direct and indirect taxes, it also covers things like PAYE, repayments, penalties, interest, tax credits, everything. So it's a very, very broad term. And the position that they can examine and use these compliance checking powers to review is your position in the past, the present, and the future. In other words, it's everything. Even, in fact, things which have not yet crystallised as a tax liability are within the scope of this power. Its universality is remarkable. And of course, this kind of power of access to allow them to sort of just check whatever they fancy without any sort of precursor having to sort of not be satisfied with an assessment or open an inquiry, just to go and have a look, is something that the revenue have wanted to have probably for since it started pretty much, and it's certainly something which has swept away impediments to them getting face-to-face with taxpayers, and also something which has swept away a vast number of statutory safeguards that allowed taxpayers to say, well, wait a minute, why are you doing this, and so on. All of that stuff is out of the window nowadays. And so you look at past, present, and future, which is what they can look at, and you think, right, what are the practical implications of this? What does it actually mean? Because what Schedule 36 gives them is a right to go around and have a look at stuff in real time. And so you think in terms of a VAT visit or an employer compliance review or something like that, and you think, well, it makes sense. If you go around and have a look at your client's records now, you'll be able to, look at their PAYE documentation, look at their VAT records, and you'll be able to see something about their tax position in relation to those matters, won't you? Because they're real-time, transaction-based taxes, basically. So you can see that the power sort of makes sense. But what about direct taxation? When you go around and have a look at your client's records, if you went round to your client today and had a look at those records, what would you actually be able to tell about their tax position? Virtually nothing. Because before you could say anything about it, an accounting period would have to end. Then you'd have to prepare accounts with all the adjustments that entailed. And then when you got that far, you'd have to prepare a tax computation. It would only be then, which might be in real terms, a year down the road, that you're actually going to be able to find out what their tax position is. So what is the point of these powers in the context of direct taxation? And that, of course, is where the enormous change has come. Okay, this is where the past and the future come in. Because let's supposing that you go around and you have a look at the records in real time and you have a look at the invoices for advertising. Some of it is undoubtedly entertaining expenditure. And you have already risk assessed the case, and you know very well that nothing was ever added back in computations in the past for entertaining expenditure. You would have the ability, under this legislation, to ask to see the records for previous years as well, to see whether or not there are any additions due for earlier years for which returns have been submitted. And this is an example of what this legislation is designed to do. The Revenue Administration is almost slimming down its sort of workforce very considerably, and they cannot afford nowadays to take up inquiries speculatively. They've invested vast amounts of money and resource in risk analysis, in predictive risking, in analysis of accounts, and so on and so forth, to identify what they think might be suitable cases for treatment. And so when they go around there, they will already know what the risk areas are, and they will be looking to test it. If they go around and find that cash control is poor, that always has been route one into investigations in the past, and it will remain so. This gives them an opportunity to assess that and see. And what about the future? You think to yourself, well, what's a future tax liability? Again, it's all about identifying suitable cases for treatment. This is what the power gives them, because let's suppose that they go around to your business premises, or your client's business premises, and they see that some work's been done on the premises. Under this legislation, they would be entitled to ask not just for the invoices for the work done, but for your planning applications, your architect's plans, your quantity surveyor's bills, anything that they fancied seeing in relation to that. And of course, if, as so often happens when they ask for all that documentation, all they actually get is one invoice from Bob the Builder saying work done £50,000, they know that when the accounts and return go in due course, showing deductions for repairs and amounts claimed for allowances on integral features and so on and so forth, there is no contemporaneous basis for apportioning the single unitary cost. And so it becomes far more worthwhile than turning to and looking at that return rather than another return, because they have identified a potential source of return if they take it up. And so it's all about identifying the vulnerable cases so that they do not have to undertake speculative inquiry. This is what this power is all about. It's a real sort of doomsday weapon. This is an extremely intrusive power that they have, and it is almost limitless in its scope, really. You have a look and see what they can have a look at. They have got an unappealable right to real-time access to your business premises, which of course includes any part of your home that you use for your business, to your business assets, and to your business records. In other words, this really does open the doors for the revenue outside the context of an inquiry or a discovery assessment or anything like that to come round and just check the cases which their risk analysis procedures have suggested are worthy of scrutiny. Now, we haven't really seen them yet. We've only just started to see them really being used in the sort of, general world of taxation, even though they've been there for years, because the revenue wanted to get it right when they hit the ground, so they hit the ground running. And of course, as I say, there is no appeal procedure, and there can be penalties for obstructing the revenue in the exercise of these powers, which, if it can be shown that it's associated with the loss of tax, can be tax geared. So, they aren't really expecting anyone to say no. The whole ethos behind this is that it requires the cooperation of taxpayers because they have unappealable powers and they're entitled to use them. Right. Now, the forum in which we are going to be seeing this unwind later in the year is all about compliance checking. And compliance checking is the sort of new revenue buzzword really for all of their compliance activities. It covers everything. It covers all taxes. It includes VAT as well. And it looks to check at a low level, in other words, at the business record checks and other things, and it will also apply just as much to full-blown investigation. So compliance checking really is, from now on, all that there is in UK taxation in a sort of compliance and investigative sense. And over the past 2 years, as some of you may be aware, the Revenue have been road testing and trialling what they term the single compliance process. And the basic idea of the single compliance process is working, or revenue working, faster and smarter. Because when they realised that they had been set, the sort of central spending review had set them these targets, they got just short of £1 billion, and they were told they had to make 7 billion in compliance yield and be able to relate it directly to it. They had a look at what they were doing. And they found that an average investigation would take an inspector, say, 80 hours of time. And, 80 hours, well, it is what it is. But the trouble was that the 80 hours was spread over 2 or 3 years. And so it was an incredibly inefficient process. And it was realised fairly early on that if they didn't change the way that they worked, they would never they'd have no chance at all of achieving these rather stretching targets that have been set for them. And so the single compliance process was designed to make sure that things worked in a far smoother and principally faster way than ever before. And so we are looking now, if the SCP goes in its sort of evolved form, at cases which have already gone through a rigorous process of selection and analysis and research before the first letter is even, the first contact is even made. We are looking at cross-tax working, so that investigations nowadays will focus not just on one particular area of your fiscal affairs, but right across the board to make sure that sort of maximum outcome is achieved from the effort that they're putting in. If HMRC don't sort of enlist the help of professionals acting for clients, then they are going to struggle to achieve any real benefits in terms of speed of working. We have to work together, in other words, to get through the process. And so, for example, one of the things that they've done is realise that the Openness and Early Dialogue project, which you remember no doubt from a few years ago, was actually extremely successful. And so going forward, the new idea is that when an inquiry opens, given that the Revenue will have a pretty good idea of what they're looking for, it's not just the usual thing of, send me the records and I'll hang on to them for 3 months and then send you a 15-page letter saying everything I want to look at. They should know before they even open an inquiry or undertake a compliance check what it is they're interested in, and they are, according to principles of the SCP, supposed to tell you, unless they feel that there is active evasion, in which case they won't do. But that would be a very different kind of inquiry. But in the normal way, what they're supposed to do is tell you up front what the problem is, which of course for us is great, because it's no longer a sort of game of poker trying to second guess what you're going to be asked. You will know what you're going to be asked, so you can sort of focus your efforts and your response and your client's attention on the areas where the Revenue need information, so that the thing can be done and dusted and got out of the door sooner rather than later. There is also a big emphasis in the new regime on meeting the taxpayer as soon as possible, and also, of course, on accessing business records as soon as possible. So there will be immediate requests for business records, but possibly just in niche areas if the review concerns those niche areas, but possibly for the entire business. And they have indicated that if they aren't supplied within a very short period of time, then an information notice will go out so that they can start penalising for non-compliance as soon as possible. So there is a sort of, no mucking about. So it's not something that can be taken lightly, because of course all that sort of thing impacts seriously on penalties. You need to stay away from information notices if you want to do the best possible job in terms of penalty mitigation for your clients going forward. And so it is really important to understand in practice what this actually means. There you go. And of course, given that the basic idea is that they want to get face-to-face with taxpayers as soon as they can possibly manage, this means that, again, we have to change the way that we act. Because a lot of people are saying, well, taxpayer clients should never meet HMRC. Under the single compliance process, you could still adopt that, but you're going to find the cases much harder to work. It is much better to realise that at some stage the meeting is going to take place, and that, therefore, the best answer is to engage quickly with your client and tell them exactly what is up for grabs, particularly in terms of potential penalty risk, because to a very substantial extent, that is where what we do makes a difference. Yes, we can argue the sort of technical position, and we can argue the sort of quantum of any additions to profits, and so on and so forth, but a large part of what we are going to have to do in the future is going to bear on reducing the impact of penalties under Schedule 24, and that is all about how taxpayers behave and what the quality of their disclosure is.